Markel Group, a Berkshire-Style insurance and investment compounder. Overall verdict, yellow. Watch. Markel was founded in 1930 and is headquartered in Glen Allen, Virginia. It runs on 3 engines: insurance, investments, and Markel Ventures. The insurance engine underwrites specialty property and casualty risk. The investments engine takes the float that funds and invests it, much like Berkshire Hathaway. And Markel Ventures owns about 20 non-insurance operating businesses. In May 2023, the company renamed itself from Markel Corporation to Markel Group to formalize that 3-engine structure. CEO Tom Gaynor, a respected value investor, has run the investment portfolio since the 90s and became sole CEO in January 2023. In August 2025, Markel sold its global reinsurance renewal rights and exited that business. Price versus intrinsic value. Current price, $1,972. DCF base case, approximately $1,845 per share. That's a 7% premium to intrinsic value, not a bargain. Price to book, 1.32 times, right in Markel's typical historical range. For an insurer, book value per share is the more important number than free cash flow, and it has compounded at 10.6% annually for 7 years. Bull case, $2,443, if that compounding continues, and the market re-rates the stock toward a higher quality multiple. 4 numbers define Markel. Book value per share, $799 in 2019, $1,465 in 2025. A 10.6% compound annual growth rate. Combined ratio, 95% in 2025. Underwriting profitable in 18 of the last 20 years. Share count down 8.4% in 7 years via buybacks. This is a compounding machine, not a growth story. Phase 1 Forensic Screen. 3 of 8 signals triggered, but the most important finding here isn't a business signal at all, it's a data problem. Our data vendor's total assets figures were wrong in 4 of the last 7 years, understating Markel's real balance sheet by $7 to $15 billion. In 2019, 2020, 2023 and 2024. We cross-checked and corrected every figure using independent sources. The genuine company-specific concern. In the 4th quarter of 2023, a reserve study forced adverse development on general liability and professional liability lines. Underwriting profit fell from $627 million to $133 million. The 2022 net loss, by contrast, is fully explained. $1.6 billion in investment mark-to-market losses, an industry-wide event. Phase 2 Financial Analysis. Revenue for an insurer includes volatile investment gains and losses, so it isn't a clean growth metric. It ranged from $9.5 to $16.8 billion. The far more reliable metric is book value per share, which grew every single year except 2022. Share count fell from 13.9 to 12.7 million. Real per share compounding, not dilution. Margin trend for an insurance holding company needs a different lens than gross margin. The metric that matters is the combined ratio. Premiums collected versus claims and expenses paid. Markel's combined ratio was under 100% in 18 of the last 20 years. Meaning the company gets paid to hold and invest its policyholders' premiums. 2022's net margin of negative 1.8% was an investment portfolio event, not an underwriting failure. DuPont decomposition. Return on equity swung from 16% to negative 1.6% to 16% again, driven almost entirely by the net margin lever, not asset turnover or leverage, both of which stayed remarkably stable. Financial leverage held in a tight 3.3 to 3.8 times band. Throughout the entire 7-year record, Markel has not leveraged up to chase returns. Phase 3 Moat Assessment. 5 of 9 10-minute test filters pass. Verdict narrow moat. The evidence, a combined ratio under 100% in 18 of 20 years. Funding investable float, the same structural advantage that built Berkshire Hathaway. But this moat is earned through execution and culture, not a structural barrier. Specialty insurance is a competed market. W.R. Berkley and RLI are credible peers. And the 2023 reserve study is direct evidence that even Markel's own underwriting discipline can lapse on long-tail lines. Phase 4 Capital Allocation. Verdict: green, the strongest phase in this analysis. Markel pays no common dividend, full earnings retention, exactly like Berkshire Hathaway. Buybacks grew from $116 million to $573 million, funded entirely by growing free cash flow, not debt. Financial debt to equity fell from 0.36 to 0.23. And in August 2025, management made a genuinely outsider-style decision, selling the global reinsurance business rather than defending it for scale's own sake. Phase 5 Competitive Dynamics. Verdict narrow. Markel's powers are real but moderate. Partial scale, partial branding. Partial process power in underwriting and investing. No network effects, no cornered resource, no regulatory monopoly. The most relevant comparison is Berkshire Hathaway and Fairfax Financial. Markel runs the same playbook at smaller scale, with more room to compound, but less diversification and negotiating power. Overall verdict: yellow. Watch. Markel is a genuine, proven capital compounder. Book value per share up 10.6% annually for 7 years. Despite a 2022 investment-driven loss, the moat is real but earned, and it showed a genuine crack in 2023, when a reserve study forced adverse development on long-tail casualty lines. Capital allocation under Tom Gaynor is disciplined and shareholder-aligned throughout. At 1.32 times book value, the stock is fairly valued, not cheap. A conservative base case suggests shares are roughly fully priced today. This is a name to own for steady compounding, not a special situation bargain. 10-minute quality test, 9 filters. Positive operating cash flow, pass all 7 years, no exceptions. Ever profitable, yellow. 1 net loss 2022 investment driven. Return on equity above 10%, yellow. Below threshold in 2 of 7 years. Clean balance sheet. Pass. Financial debt to equity 0.23 to 0.36. Share count, pass, down 8.4% via steady buybacks. 5 of 9 pass, 4 yellow, no outright fails. Share count, 13.9 million in 2019. 12.7 million today, down 8.4%. Markel pays no dividend, so buybacks are the primary direct capital return lever, growing steadily alongside free cash flow. Buybacks grew from $116 million in 2019 to $573 million in 2024. No dividend has ever been paid. 100% of distributable capital is retained or repurchased, the same full retention approach as Berkshire. Financial debt to equity, 0.36 in 2019, down to 0.23 in 2025. Leverage assets to equity has stayed in a tight 3.3 to 3.8 times band throughout, corrected for a data vendor error that understated total assets in 4 of the 7 years. 3 valuation methods, adapted for an insurer. Price to book, 1.32 times, in line with Markel's own historical range. DCF base case, 8% forward book value growth, 1.3 times target multiple, implies $1,845 per share, a 7% premium today. Bull case at the historical 10.6% growth rate, $2,443.